welcome. We are now a top 30 full service accounting firm. We have over 400 staff and around 50 partners. The new top 50 plus 50s come out, so we are now officially a top 30 firm because that was released earlier in the week. So well done to everybody who's been part of that. Alongside being a full service accounting firm, we are also a member of the FK International, which is an incredibly large global network of similarly minded independent firms and advisors. This enables us to help our clients wherever they are, whether they're expanding into international jurisdictions, whether they're thinking of moving themselves, their people, their families, anywhere in the world. We do all the things that every big firm of accountants does. We do audit and accounts, tax compliance. We have a very, very strong tax advisory function. And I am at the moment in the process of advising a number of businesses on the exit end of their inception to exit strategy. At the moment, there are many ways that you can leave your business when you've decided that the time has come. And one of the key things that I've learned over the years is there's two great times for planning your business. One is before you start, and the second is now. There are no do-overs. So the transactions I'm working on at the moment are a management buyout for a client of mine. He's decided he's going to retire. And the management team is sufficiently strong, and we've created a deal that allows them to take control of the business. And he will gradually, over the next few years, step away with some cash in his pocket. I'm also working on a couple of other transactions that are interesting. The bottom one, which is the £600 million upstream acquisition, effectively my client created a software business about 10, 12 years ago. I advised them on the structure and the setup of that business when it first started. This is one of those unicorn type businesses that everyone dreams of founding. They have done incredibly well. They've made some significant profits. And now one of their customers wants to buy them and absorb them into the group. And so they're looking at potentially around 600 million as a sale price for the business, having formed it 10 years ago. Alongside some of these amazing success stories I've seen, they've also been the ones that have been a brilliant idea, wrong place, wrong time, wrong market, and haven't gone the distance. One of the things that we need to be very conscious of when we're starting our businesses is where are we trying to go with it? And that's why actually using your professional advisors as a sounding board throughout the lifespan of the business is really helpful. I speak to my clients at least once a month and go, what's on your mind? What are the problems you're facing now? How are you getting on with where you're trying to get to? So we're going to cover 5 key points, which go through the 5 phases of a typical fast-growing business. We're going to look at how you optimize the tax structure. And the one thing to bear in mind is don't let the tax tail wag the dog. Don't make decisions based on it being tax efficient if it's bad for your business. You will always be given alternatives as to how to improve the tax structure of your business. But one of the key things is to make sure it doesn't interfere with what you're trying to do with the business itself. We're also going to look at ways to raise investment throughout the lifespan of a business and how to do that as tax efficiently as possible. In a lot of scenarios, there will be a number of ways you can go. And there will often be 2 equal choices, one that comes with a tax break and one which doesn't. So it's making sure you understand what the differences between those 2 are. So typically for a fast-growing business, there are 5 phases. Phase 1, which I've classified as idea and exit strategy. As I said, the best time to plan your business is before you start it. The second phase is okay, where does the money come from? You've got a great idea. How do you then get it off the ground? You then grow, you then expand. You may need more external money to do that. A number of businesses will be capable of generating enough profitability to fund their own expansion. Others will need a little external help. And the final phase of this is, how are you getting out? So when you're in that first phase, you've got to look at what are you trying to do? What is this business going to look like? Who are you going to buy? Who is going to buy from you? Who are you going to buy from? Who is going to get in your way? And how much is it going to cost to actually get the business off the ground? one of the big challenges a lot of startup businesses have is where does that first slug of money come from? Often it comes from friends, family, because at this point, banks, private equity, professional investors aren't that excited about a business because at the moment it's an idea and no more than that. And you've also got to look at how you structure that business. Is it going to be a company? Is it going to be an LLP? Is it going to be a traditional old school partnership? And there are a number of advantages to each of these structures, and these need to be considered ideally before you start. For instance, I now take accountancy as a sort of a background because this is where I've worked all my professional career. Typically, accountancy businesses are structured as limited liability partnerships. The reason for that is it makes it easier to get new partners in and for old partners to leave. In a corporate structure where the partners would own the business, you end up having to do transactions with the shares every time somebody came or went, and that would create an unnecessary burden. So once you've got the idea and you know exactly how you're going to try and deliver that, why are you thinking about the exit now? You haven't made your first sale, so why think about the exit now? A lot of businesses end up drifting. They get to a certain size and they kind of tick the box for, well, I've done what I thought I could. A lot of businesses will end up in this strange sort of netherworld where they're chugging along, but they've lost the enthusiasm they had when it started. So at this point, it may be you have a 5-year plan, a 10-year plan. Okay, I'm going to start this business, and in 10 years' time, I'm going to sell it for 20 million quid. It's a great idea. It's entirely achievable. But you've got to think about, okay, in 10 years' time, when you're looking for that 20 million quid, who's going to put that money up? Are you going to sell out to a competitor? Are you going to sell out to one of your customers? Are you going to sell out to a supplier? Are you going to go for a listing? Are you looking to retire at that point? So it's thinking about who could buy this business and where's the money going to come from to do that? And what they might want. Probably at the very first stage where you're still in the ideas phase, thinking about what a purchaser might want it to look like in 10 years' time is probably a little bit premature. However, don't do anything at this point that will prejudice what you're trying to do down the road. And the other question is, if you are going to sell it in 10 years' time, how big and how profitable does it need to be? The key things there are most businesses, and there are a long list of exceptions, are sold on multiples of profits. EBITDA, earnings before interest, tax, depreciation, and amortization. And that's become an industry standard for how you value a business for the purpose of buying and selling it. So if you want 20 million, typical EBITDA models say you get a 6 to 8 times multiple. That varies enormously between sector. Some it's as low as 1 or 2 times. In some, it can be as high as 30 or 40. If you're in a very desirable, fast-growing sector where there is a causal link between this is how profitable the business is now. If we doubled it in size, we treble its profitability because our costs would stay very similar. And it's timeline. You've got to think, okay, who am I going to need on board over the course of this journey? What skills do I have? What skills am I going to need to buy in? So when you're initially looking to raise money for a business that hasn't yet started, we're now in a phase of looking at a seed enterprise investment scheme. It is a tax-advantaged investment. And typically, a lot of the money for a very brand new business will come from friends and family. Whilst there are some exceptions in terms of how close a family member it could be and still get a tax-advantaged investment, generally your spouse, your parents and your kids won't get the tax breaks, but a benevolent uncle or aunt may be able to put in money and get a tax advantage in doing so. What SEIS is effectively a subscription for shares, and because the government acknowledges that it is a risky investment, then you get a tax break. So if I put £100,000 into my brother's business, I would fairly immediately be able to claim half of that back against my own income tax. If that business goes on to be mega successful, I could then sell the shares and I wouldn't pay any capital gains tax on the end. You are limited as a company to how much you can raise. It used to be 150,000. Due to inflation, the government in their infinite wisdom has decided that 250,000 is now the right number. But that's the maximum for the company. The investor maximum is £100,000 per individual. And this is for very, very early stage businesses. SEIS has a big brother, the Enterprise Investment Scheme, which I'll come on to talk about in a little while. It is designed for businesses in their next phase that may need a lot more money than that. The advantage of doing an SEIS round is you can do another round alongside it. So if your parents want to put up some money or your spouse has some money they want to invest, it doesn't go against that £250,000 limit, it stands aside from it. But it is designed for very small companies with gross assets of under 350,000. So it is an early stage benefit. As with everything the government does, they give with one hand, take away with the other. So there are an awful lot of conditions that attach to this. It is very easy to slip up and end up putting yourself in a position where you think, or you've spoken to potential investors and say, yes, you'll get this lovely income tax credit and an exemption from capital gains tax. But there are hurdles you have to clear. And this is where the specialist advice comes in, saying, okay, that's fine. If you do this, you will lose your SEIS and EIS status. But again, commercially, it may be beneficial to do that anyway. But it's making sure you understand the upsides and the risks before you make that decision. So once your business is up and running, you may need key people. You may not have all of the skills you need to build the business you want to do. So bringing in people at this stage of the business where the business will be watching its cash flow, almost certainly, you can qualify for EMI, which is a share option scheme for key employees. It is a great way of bringing in people, good people into your business, and it also saves cash flow because essentially you're not paying them all of the salary or bonuses or other contributions that you may normally. Normally, businesses would say, okay, the salary is 50,000, but we can do a salary of 40,000 and give you some share options. And for a lot of people, that'll work. And certainly for key people, thinking about having an equity stake in the business is important. It creates a tie to the business. And where it's a share option scheme, there will be conditions that you can attach to the exercise of those options. For instance, a very simple scheme may be, you sign up today, you get an option over 10% of the shares, but you need to stay with the business for 3 years to be able to benefit from that. If you leave within the first 3 years, the options fall away. And the key is here, who are the staff you need to incentivize in this way? I've seen some businesses do extraordinary things whereby they've given people relatively small numbers of options, which have then gone on to become incredibly valuable. The £600 million transaction I was talking about right at the start, some of the option holders there who were in at the ground floor when the business was still in its very early stages are looking at walking away with 10 to 20 million pounds. And they will also benefit from some tax breaks on that. Okay, you've got the first £1 million of proceeds is taxed at 10%, 20% thereafter. Salary, particularly for high earners, can be taxed at up to 47%. And whilst we don't know what the next government will do, as we all expect there to be an election at some point next year, these reliefs have come across a number of EMI's been around for probably the last 15 years, possibly even a little longer. So it's making sure that these things, assuming they stay in place, and we have no doubt that they will, it's looking at how much of the equity do you want to give away? A lot of early stage businesses will simply go, oh, well, you're coming on board as our chief financial officer, therefore we'll give you 10%. But actually, if you're building a business that's going to be worth £20 million, that 10% may end up being worth £2 million. Is that what you wanted to achieve with that? And the key with any share option scheme is making sure the people who have the options understand why it's good for them and what they need to do to benefit from it. So if you're going to put performance conditions on it, I mean, the simple example that's always used is you're a salesman. If you make sales of over X pounds, then you get to exercise some of your options. But it ties the people to the company. One of the other benefits from a share option scheme is that at the point where the employees exercise their options, the company gets a tax deduction for the difference between what would normally be the proceeds or market value for those shares and what they actually pay for them. If you launch an EMI scheme right at the start of the business, the shares are probably not worth anything. But in my example, you've given 10% to your financial officer, and he's entitled to £2 million worth of proceeds on a sale, then you would get a tax deduction for that £2 million. And one of the things that I find often is I deal with as part of transaction work is arguing with the buyer about who gets the benefit of that tax deduction. My view has always been that it belongs to the seller, although occasionally when I'm being asked to act for the buyer, strangely because it then occurs at a point when after the buyer has taken control of the business, it should belong to the buyer. But again, that's me being appointed and delivering for my client. Once you've had some growth, there are other things you need to consider. One of the downsides, I suppose, of doing EMI is that you're in a position where you're giving away shares in the business. And ultimately, that's diluting the amount that you're potentially going to get from this. The alternative to equity structuring is to use debt. Go to the bank and say, I'd like to borrow some money. Banks will, on the back of a good business plan, be prepared to lend. And if you've got the right business plan and the right business structure and the right profitability, a lot of banks will be prepared to offer you finance. The key is understanding who will offer you the best deal. And where we have a lot of experience of working with these banks and organising dozens of transactions a year, we actually see more of the market. It's not just a case of you phone up your bank manager and say, you know, my business wants to borrow £1 million. They're actually looking out in the market and seeing what's there. All of the banks will be different in terms of what they offer. The covenants point is simply the banks will have an expectation of what you will give them beyond simply the interest on the capital they've lent you. In some cases, they will require you to maintain a certain level of profitability. They may prevent you from paying dividends to yourself in the event that you don't meet them. Some lenders will be absolutely insistent on a personal guarantee. The danger with a personal guarantee is that if the business fails, the bank will come after your personal assets, which may be your home. Some lenders will not insist on personal guarantees, but will charge you an additional interest rate. They will take a security, but they will take security over the company's assets rather than your own personal assets. And many clients would actually say, okay, I'll pay another 1% on the interest rate in order to avoid the potential for my house to be put on the line here. One of the benefits that I wanted to talk about today, but then they came up in the autumn statement last week, is R&D. I've been involved in this since the regime launched about 1 million years ago. And it is surprisingly wide, and despite the fact that it's getting progressively less generous, it is still a splendid way of saving tax. If you are doing things that are innovative, and part of the government's wording on this is very strange and makes it sound unnecessarily complex. They talk about an overall advance in the field of science or technology. Well, what does that mean? It means you're doing something new, something clever, something different. And if you're doing those things, then it's worth having a conversation about whether it's possible that that falls within R&D. R&D has got a bit of a reputation of doing the men in lab coats will qualify, but I found out that actually, whilst they probably do, so many other businesses do. I do a lot of work in the software and technology sectors. I've made claims across a huge variety of industries, including jewelers, waste management. I've even done 1 or 2 in food. Again, as long as you meet the criteria, there's a benefit there. And if you're a profitable company, that's still worth 21.5% tax savings. So if you spend £100, you'll get a tax break of £21.50 based on £100 to spend. If you're loss making, there is a tax credit available. And a lot of businesses plan around the benefit from this. So it aids the cash flow. So if you spend £100, when you file your tax return, shortly thereafter, you should get a credit back for 18.6% of what you've spent. The autumn statement did radically change the landscape for R&D moving forwards. It was pressed downwards in the budget earlier in the year, but in the autumn statement, they've decided that where there had previously been 2 schemes, an SME scheme for small and medium-sized enterprises, and what they call an RDEC scheme for large companies, These are now being merged together. There are a small exception for knowledge-intensive small companies that will be able to continue under the old scheme after April next year, but most businesses will fall into the merged RDEC scheme. It's a little disappointing to see that for some companies where 2 years ago, if you were a small loss-making startup and you were claiming R&D, you could get a refund of almost a third of what you spent. That's been broadly halved with effect from April next year. But it is still a valuable relief. If this kind of innovation is key to your business, you are going to do this work anyway. So having a little bit of a subsidy kick back to you after the event is really handy. And as part of your getting to the next level, this is the point where you've built a business that is hopefully profitable, but either way is got enough substance that external investors that aren't known to you will start to become interested. Whether that's angel investors, so wealthy individuals, whether that's other vehicles. EIS, again, it's like SEIS. The limits are much higher. You can raise £5 million in any 12-month period or £12 million in total under EIS. The tax breaks for the investors are exactly the same as SES, other than the income tax credit is only 30% rather than 50%. But the limit on how much you can invest per individual is £1 million in any tax year. But as the business has got bigger, you may have more than one class of shares. And therefore, under EIS, the condition that they must be full risk ordinary shares will start to come into application. There will be some investors who are looking for preference shares, so almost a fixed rate of return and a minimal risk on their capital. Again, for some businesses, they're in the privileged position of being able to choose between the two. But if you're taking on EIS money, it will dilute your share of the business. And it's key to understand how much. I mean, I've watched enough Dragon's Dens to see companies and their owners go in there going, oh, I'd like to raise £1 million for 10% of the business. They've made sales of £100 to 3 of their friends, but that value of 10%, £1 million for 10%, values the business at £10 million. How is that coming into fruition? And it's about understanding the value of your business at that point to know how much you're going to dilute your own equity through the issue of these new shares. Venture capital trusts are essentially an EIS club. So if I was to invest in a VCT, it would enable me to spread my investment. So I put my £100,000 into a VCT. The VCT invests in, say, 10 different businesses. And my return will be based on what all of those businesses collectively do. The benefits of that in some cases is you may get some support from the VCT in terms of they may choose to seat someone on the board of your company. That may limit what you can do as a founder, but it may also provide you with a different perspective. And I've certainly seen this work very well for businesses that have 1 or 2 shareholders who have come from a similar background. They're having a third person at the table who has got a completely different point of view is obviously very helpful. You've got the same issue there with the dilution of equity, but again, anytime you sell shares, that's going to be an issue. But it's making sure that if your goal is to sell for 20 million after 10 years, that actually you've got enough of the equity left. So it may be that the investment you get here means that you'll sell the business for 40 million. And if you own 80% of 40 million, that's going to be better than owning 100% of 20. So it's making sure you're getting value for your investment. There are a couple of other ways to do it. I've been involved in businesses that have very successfully raised crowdfunding. I've also had to break it to a number of other businesses that they are simply not cool enough to be crowdfunding. I acted for a business that makes small tools. They do a brilliant job, they make loads of money. And if they raise investment, then they will turn that into profits and they will turn that into cash. But they are not cool. On the other hand, I've seen businesses that have very little substance. And if you look on most crowdfunding platforms, you'll find some very optimistic projects on there seeking to raise very substantial ways of money and doing it successfully. So I think one of the key things there is to understand whether what your business does will appeal to crowdfunders. The advantage, if it does appeal to crowdfunders, is that you have a platform where you have a substantially greater reach to potential investors than you would do on your own. It also means that the crowdfunding platform will organise the collection of the money and organise in some cases, will organise the distribution of the shares after the money has been raised. It is a slightly cheaper way than doing it than approaching 100 individuals when you can project out into the marketplace on a wider level. One of the benefits of crowdfunding is there will be some investor due diligence. They will expect you to put up a set of financials onto the platform. You may be asked questions about them, but it's fairly light touch. What it doesn't do is add any real experience and expertise to the company itself. So if all you're seeking is cash and you have a cool business, great. But if you're looking for more from an investor, and a number of these angel investors that potentially come in through the EIS route will actually sit on your board and add something to the business itself, whether that's strategic oversight, whether that's just the benefit of experience. It depends. You won't get that through crowdfunding. And failed raises are not uncommon. As I said, there's a brilliant business that I work with that thought about doing this, and I could tell from the start that it wasn't going to fly. Instead, we introduced them to somebody that we know who has an expertise in that sector and has made a lot of money over the years, and he put up the money personally because he's less interested in what sector they're working in, and he's more interested in how they turn his investment into a return for him. So he's sector agnostic. It's about the return, it's not about the business itself. And this is the point where I have to be a little bit careful. Private equity is often pilloried in the mainstream media. Gravita itself is owned by private equity. And what we have found is that they have brought in a whole host of management, leadership processes that have actually really helped our business. The people on board know what they're doing, they're experienced, they're well connected. But they will impose limits on the business. As 12 months ago, I was a partner in a firm called Carter Winter. I'm now an employee of the Gravita Group. I can't do everything I used to be able to do, but equally, I've been questioned a lot about, well, why are you doing it that way? And in some cases, because I always have, is not the right answer. And private equity are usually fairly single-minded. They have a purpose when they make an investment, and they will look to what they can return and how to do it. They will be clear on strategy, clear on reporting, clear on how they're going to deliver their outcome. And often that is really helpful for businesses that have drifted a little away from their core original purpose. But they will have an impact on the freedoms that the business owners used to have. There's also a couple of other things I want to mention at this point, because at this point you may still be needing to add key people to your team. EMI is limited in what you can do in as much as once you get to a certain size, it's no longer available, or the price of the shares becomes too high. You can do unapproved share options, and at this point, unapproved share options is brilliant. They are completely flexible. You can issue them to whoever you want under whatever terms you want, because there are no tax advantages, there are no hurdles. This means that if you've got particularly key subcontractors or consultants that aren't employed full-time by your business, then an unapproved share option can be a solid way to go. It also means that if you want to do things that aren't in alignment with the way HMRC perceives EMI should operate, you get the freedom to do that under an unapproved share option. The one limitation that we find on options that occasionally comes to bite is that an EMI option has to be capable of exercise within 10 years. If you're building a business with a longer term strategy than that, you may wish to issue share options that come into play, not just over that first 10 years, but one or two come in after that. It would be unusual, but it's possible under this. The issue you face in terms of the biggest downside to doing this is that generally the exercise of unapproved share options triggers tax consequences. And any gains between the time you were granted the option and the time you actually acquire the shares will be subject to income tax. And if your company is at that point in the process of negotiating an exit deal, or the shares are otherwise tradable, then that can be triggered under PAYE, which means national insurance all round on top of the onerous income tax charges. But the big benefit of this is that you have complete flexibility and discretion to do whatever you want. Growth shares are a bit of a happy medium in as much as they get away from some of the challenges of EMI without putting you into this position where most of the upside is going to be subject to capital gains tax. A growth share is effectively, you say the company today is worth £5 million. We issue a new class of shares that says you benefit in everything over £5.5 million. And because you're issued with those shares up front, you will be subject to capital gains on any upside you realise from this. The benefit of that is that obviously where you've taken out a share of the value already, it means that people acquire shares and then pay capital gains tax on it. It takes you away from the possibility of needing to operate PAYE on it later, which means you're almost guaranteed to be free of national insurance and income tax. The downside of this is if the value of the business is moving very slowly, there may not be enough in it for the people you want to benefit from it. The other thing is, if you are going to issue these on a regular basis, you need to revalue the company frequently. And that comes with cost implications as well. You may also need to change any shareholders' agreements or articles of association to create these new classes of shares. It's not fundamentally different to the process you need to go through with a share option scheme, whether that's EMI or unapproved. But these are things that you will need to consider, and you will need to talk to professional advisors about this. And most are familiar with growth shares, often called flowering shares or blooming shares. They've got a number of different ways, but simply it's a way you are excluded from the existing value of the business, which means the shares are therefore worth very little, which means you can afford to buy the shares on day one. When you're in this expansion phase, the other thing to think about is, if you are going to sell in the near future, is your structure still right? You will have looked at this a number of times over the life of the business, and it may be that the answer is yes, in which case, brilliant. But by this point, you may have also got a number of sort of side projects or excess assets or non-core businesses. So you may have started out going, well, this is the business, and then you've gone, so a client has asked you to do something, and you've actually built a business off the back of that. So you've got to think about, is a potential buyer going to want the whole thing? Are they going to want some of it? One of the things that we see very often in transactions is that buyers will potentially not want the trading premises. You know, we've acted for a number of companies that own their business premises, and the buyer's going, well, I want the business, but I don't want the premises. I'm quite happy for you to keep the premises, and we'll just pay you a rent under a lease. That's fine. We can do that. But we have to think about the structure at this point so we can actually break up the group to make it more saleable. If you've got a lot of companies in the group, are all of them necessary? If you've only got one company, are they doing different things? So would a buyer want you to split them into different companies so they can manage the risk of that better? I'm going to mention audit at this point simply because a lot of buyers, particularly if they're very big buyers, will want the reassurance of an audit. The upside is it gives you a robustness to your numbers. The downside is its cost. Vendor due diligence is slightly different to audit. It's like Audit Plus. Effectively, what this means is that you, as the owner of the business, appoint a professional firm to look at what a potential buyer would find if they did a due diligence on you. And due diligence is basically they look under the bonnet. Are there any issues? Are there any risks? What has gone wrong? What could go right? And produce a report for you. And one of the benefits of that is that you get an insight into what would be found if a buyer did it at a point where you're still able to fix it before a buyer is in the frame. There are a lot of firms that are quite good at this. There are a lot of firms that are not so good. I'd strongly recommend Gravita. We're great at this. We do a lot. I spent half my life doing tax due diligence, whether that's on transactions themselves or whether that's the vendor due diligence where I'm doing it for clients of the firm who are looking to exit. There are a number of partners that do very similar things. Now you've got to the point where you've built the business big enough to actually exit. Who's going to buy it? A private sale is always good. You've met someone at the golf course and they've gone, you know what, you've got a great business, I'd like to buy it from you. Unusual but not unheard of. MBO and MBI, and I appreciate that anything to do with tax has turned into a bit of an alphabet soup. Here we have management buyout and management buy-in. Generally, a management buyout is the final stage, as in you as the owner will leave the business within a period of time after the deal is done. A management buy-in is usually a preliminary step whereby you've got really good people and you go, you know what, I will sell you 50% of the business now, and if it all goes well, I'll sell you the other 50% later. Upstream and downstream basically means you're either selling out to a customer or a supplier. It may be that you merge the businesses. It may be that you retain an interest after the deal. An IPO is a listing. So you decided to go to the stock market and say, you know what, I'm going to let the general public buy our shares because we've got that great a business. Of all of the options on the table here, the IPO will be the really expensive one, because you're going to be put in a position where you're selling shares to the general public. The regulatory hurdles are significant. We've advised on a number of IPOs and they've generally been fairly successful, but it is an expensive process. There is also now a new option that's come on the table over the last few years called an employee ownership trust. This is where you effectively sell the company to a trust that is set up for the benefit of all of the employees of the company. So this turns employee ownership into a reality. This is a difficult area. This is a relatively new area. It is an area I have quietly avoided like the plague, which is why one of our tax consultants, Tim Palmer, will be running a separate webinar on precisely this topic and this topic alone in a few weeks' time. Assuming you've got a transaction that's going to go ahead, or you're looking for one, do you need help marketing the business? We have access to databases and client lists of businesses that are looking to do acquisitions. Are you going to need some support with due diligence? Generally, what we find is medium-sized companies that are looking to sell suddenly find themselves face-to-face with 20 of the finest from PwC or BDO, asking questions about everything under the sun to do with the business. Professional advisors are very helpful in this situation because we know what the right answer to these questions should be. We also know how to filter information to make sure that you're answering only the question that you're being asked. And the other point here is, what is this sale going to mean for you on a tax front? It's all well and good that you're going to make a lot of money from the sale of the business, but if you're going to have to hand a big chunk of that over to the tax man, you're going to be less thrilled than if that's a smaller chunk. And you've also got to lean on lawyers as well. Any transaction is going to come with an absolute document soup, and having a really good lawyer to help steer you through that will be absolutely invaluable. And the earlier you engage with your professional support team, the better. Because if it all becomes a bit last minute and rushed, then that's the point where the costs of the work will spiral, because you will find that instead of a partner being able to delegate to a team, they have to do a lot of the work themselves. But equally, it's making sure the channels of communication are open throughout. Once you have actually sold the business, you are probably going to be tied into that business. And typically the tie-ins afterwards are 2 to 3 years. I have a client that is about to sell, and they have spent the last 5 years making themselves obsolete because they want to sell the business and walk away immediately. And there are things you can do to do that. The other question is, if you're in your 40s, 50s, 60s, you've still got plenty of go left in you, what are you actually going to do once you've sold the business? I mean, we all like the thought that we'll be just rolling in money and then we'll buy a fancy car and we'll go and sit on the beach somewhere for a while. But how long until you get bored? And what are you going to do when you do? Are you going to start a new business? In which case, as part of the deal, you need to consider any restrictions that are placed on you. And that tie-in is often painful because you're going from a position where you are in control of the business to where you are an employee of it. You will be at somebody else's beck and call. Earnouts, and a lot of the time you'll find that you've got earnouts where The performance of the business over that tie-in period will determine your ultimate proceeds. What are you going to do with the money? Are you going to invest it? Are you going to spend it? I mean, there should always be a little splash fund for doing all the things that you wanted to do. But realistically, if you've decided that after you've sold this business, you're never going to work again, how are you going to invest that money to make sure that you don't have a position 10 years down the line where you suddenly run out of money and you need to go back into the workforce after spending 10 years out? Having a gap in your CV that long will confuse people. And one of the other things that we find with a lot of businesses, particularly trading businesses, is you go from a situation where you own a valuable company, which is exempt from inheritance tax because of business property relief, to you sitting on a large pile of cash. Cash is not exempt from inheritance tax. So if you got hit by a bus the day after you turned your shares into cash, 40% of that cash may end up in the hands of HMRC, and no one wants to see that. There are various planning steps that can be done both before, during, and after the transaction that will protect you from some of that. So at that point, you have sold your business, you're sitting on the beach, you're comfortable having spoken to your IFA that you're never going to need to work again. You've done some planning for inheritance tax, which means that you're not going to have to hand over your hard-earned gains to the taxman, and you can relax. That brings to an end presentation. If there are any questions, then they'll be in the chat. We will be sharing a copy of the slides afterwards as well. I'm going to let my marketing team see if there are any other questions. Well, whilst I do that, there are other areas that Gravita can support with beyond just planning of a business. We have very strong private client teams which deal with the individual side of it, the family tax planning. We also advise on VAT, research and development. We have a very strong international function. If, God forbid, you end up in a situation where you've got a tax investigation launched by HMRC, we are very good at people to hide behind. And it'll be a case of we will filter everything that goes both ways and minimise the traumas of having HMRC all over you, which is what generally happens in a tax investigation. We know that tax is stressful and complicated. When I started working in tax, the legislation ran to about 5,000 pages. Because HMRC and successive governments have simplified it, it now runs to nearly 40,000 pages. I don't know all of it, and I would be completely unreasonable to expect a client to know any of it. So one of the key things that we do when we're giving advice is we make sure it's easy to understand. You know your choices, and you know what happens next. Thank you all for joining us this morning. As I mentioned earlier, one of the possibilities for an exit is an employee ownership trust, and there will be a webinar on that shortly. We'd be really grateful for any feedback you've got, because we want to make these seminars and webinars better. If you particularly hated the camera, I'm not sure I'm a great fan of it, please say so. If you thought that this was quite interesting and you want some more information on some or all of the topics that we've covered this morning, let us know. We can then make it the subject of a future webinar. As all of you will no doubt be aware, unless you've been hidden in an underground bunker, the Chancellor stood up last week and changed all the rules, as he frequently does. We've produced a commentary summarising all of the things that he has thought to change and how it could affect you. So that's available on our website. I've had a small part to play in that, and our marketing team and the team of tax professionals here have put that all together. And one of the things that I guess that I've always been very proud of, and it separates our autumn statement of budget commentary from others, is that we provide a little commentary on how this could affect you. It's not just a list of these are the changes, it's what these could mean to you. And that brings us to the end. Thank you so much for joining us this morning. If you do have any follow-up questions, then please let us know. My email is there. We'll circulate the slides afterwards. So if you have a question about anything I've talked about this morning, please feel free to just drop me an email. Thank you, and enjoy the rest of your day.